Thank you for joining me. I am Ralph Bradley, and today I'll discuss fiduciary duties for governing bodies of nonprofits. We are blessed with many nonprofits that not only enhance life here, but throughout the world. Nonprofits tend to be governed by volunteers. It could be a board of trustees, a board of directors, a vestry, or just simply a committee. Maybe you were asked to join a nonprofit governing board. If so, I first want to say thank you for stepping up to serve a noble effort. But after that, I should offer my condolences, since it's a thankless task filled with fiduciary duties. Most likely, you weren't even informed of these fiduciary duties when you were being recruited. Today, I focus on the fiduciary duties toward managing your organization's financial assets or endowment.
Fiduciary. What does fiduciary mean? It is both a noun and a verb. For the noun, a fiduciary is a person or organization that acts on behalf of another person or persons, putting their clients' or beneficiaries' interests ahead of their own, with the duty to preserve good faith and trust. Being a fiduciary thus requires being bound both legally and ethically to act in the other's best interests. There are many different types of fiduciary duties. Usually the fiduciary is an agent who is acting on behalf of her principal or principals. So, the lawyer is an agent acting on behalf of her clients. A real estate agent is an agent acting on behalf of her principal, the home buyers and sellers. The corporate director has a fiduciary duty towards her shareholders. The teacher has a fiduciary duty towards her students. The guardian has a fiduciary duty over her child, etc., etc., etc.
Federal and state governments reward nonprofits for their good works by exempting them from taxes. However, the federal government has handed to state governments the responsibility to regulate nonprofits so that their governing boards adhere to fiduciary duty. The only major law governing nonprofits is the Johnson Amendment, named after the sponsor Lyndon Johnson when he was in the Senate. Basically, this law says that a nonprofit should not influence opinions on candidates running for political office. One important fiduciary duty is the management of the nonprofit's financial assets, investments, or endowment. Many organizations such as symphony orchestras, art museums, or independent schools can't finance their entire operation through ticket sales or tuition alone. They also have to rely on other financial assets. For example, according to their 2019 financial report, the Boston Symphony Orchestra has a $456 million endowment, and it covered 24% of their operating costs. Obviously, most board members don't have the time nor training to manage an investment portfolio, so a manager or a set of managers are selected to do this. Yet, it is still the governing board's responsibility that these funds are properly managed, so the board needs to ensure that the investment manager is adhering to fiduciary duty. To do this, the board needs to know what the investment manager is supposed to do, and the board needs certain information to hold the investment manager accountable. Most important, and this is key, everyone makes mistakes investing, even Warren Buffett. Carrying out fiduciary duty does not mean not making mistakes. Rather, it is to make mistakes transparent so that hopefully we can learn from them.
So what exactly is an investment manager or financial advisor supposed to do? The current Uniform Prudent Investor laws are based on the work of Nobel laureate economist Harry Markowitz and his transformative paper, Portfolio Selection. He is called the father of modern portfolio theory. Based on his methods, investing is always done in an uncertain environment. We cannot predict perfectly. Even Warren Buffett makes mistakes. The underlying principles of modern portfolio theory and government regulations are: first, know the client's risk aversion and time horizon. Second, managing the trade-off between risk and return. And third, using diversification to reduce risk while maintaining expected return. One of the key concepts in portfolio management is risk aversion, because most are risk averse. Here is a visual of risk aversion. The orange line gives the pleasures and pain of the gains and losses respectively. Economists call this utility of gains and losses. First, it is clear that a zero gain gives zero utility. But now let's compare a $250 gain and a $250 loss. The pain of the $250 loss far exceeds the pleasure of a $250 gain. A loss of $250 creates a negative utility close to negative $600, while a gain of $250 yields a utility gain of less than $200. The gray line depicts risk neutrality, so that an additional dollar in gain always gives a constant increase in utility. Most people are risk averse and not risk neutral. That is why they buy insurance. Not everyone has the same level of risk aversion. The blue line depicts the utility gains and losses for someone who is still risk averse, but less so than the person with the orange line. So one of the first duties of investment managers is to assess their client's level of risk aversion. Once investment managers understand their client's risk aversion, the next step is to use diversification to reduce risk. Here is a simple example of how diversification works. Suppose there are two securities, Acme and XYZ Corporation. Both have a 1/2 probability of loss and a 1/2 probability of gain. Under a loss, the dollar loss is $10 and the utility loss is $20. And under the gain, the dollar gain is $20 and the utility gain is $10. Remember that the additional utility coming from an additional dollar decreases as the gain increases. Now, how are we supposed to derive the expected results in either buying Acme or XYZ alone? Well, we have to multiply the probability of a loss, which is 1/2, times the result under a loss, plus the probability of a gain, which is 1/2 times the result when there is a gain. So the expected dollar gain is 1/2 times negative $10 plus 1/2 times $20, and that equals $5. And the expected utility is 1/2 times negative 20 plus 1/2 times 10, which is negative 5. So while the expected gain is positive, the expected utility is negative. And so the client would be worse off investing in either Acme or XYZ alone. In fact, the client in this situation would pay $1 just to avoid being forced to take a position in Acme or XYZ alone. But what are the expected results if we put 1/2 our money in Acme and 1/2 in XYZ? Well, under this scenario, there are 4 possible outcomes. The first possible outcome is that both Acme and XYZ could lose. And the probability of that happening is the probability of Acme losing, which is 1/2, times the probability that XYZ could lose, which is 1/2, and it equals a 4. The next possible outcome is that Acme could lose and XYZ could gain. And again, the probability of this happening is 1/4. The next one is Acme gaining and XYZ losing, and again, the probability is 1/4, or both could gain. And the results of each one of these outcomes is in the last column under the title result. So the expected gain, which is shown at the bottom, is 1/4 times negative 10 plus 1/4 times 5 plus 1/4 times 5 plus 1/4 times 20, and it's $5. So the expected gain of this diversified portfolio is the same as the expected gain when we buy either Acme or XYZ Corp alone. However, look what happens to the expected utility. It goes from a negative 5 when you buy one of them alone to a plus 0.5 when you buy the diversified portfolio. So why has this happened? Well, what has happened is when we have the diversified portfolio, the probability of a loss now has gone from 1/2 to 1/4. So diversification helps minimize the losses while keeping the expected gains. One goal of portfolio management is to minimize variation risk for a given expected return. We first start with a visual of a bell curve of an inefficient portfolio. If you have ever taken college statistics, this will be familiar. The size of the red area represents the probability of loss, and the size of the green area is the probability of gain. The expected return is 5%. This portfolio is an improvement over the initial. The expected return is still 5%, but the variation of possible outcomes is less. As a result, the probability of loss is much smaller and depicted by the red area. That is smaller than the red area in the initial portfolio. A measure of risk is the variation of possible outcomes, and the most often used measure is the standard deviation, which is represented by the Greek symbol sigma. Again, those of you who have ever taken college statistics classes will find this familiar. So the key takeaways are: risk is bad, return is good, an efficient portfolio minimizes risk for a given expected rate of return. One of the investment manager's duty is to create an efficient portfolio. And finally, and most important, among the various efficient portfolios, there is a trade-off between risk and expected return. The higher expected return requires taking on more risk. So here is a visual of the trade-off. On this graph, the y-axis measures expected return and the x-axis measures risk, volatility, standard deviation. And the green curve represents the trade-off between risk and return for all the efficient portfolios. So the green curve is the combination of the schemes of all efficient portfolios. And the blue dots represent individual portfolios. There is only one efficient portfolio on that graph, and it's this one right here that's on the green curve. So if a portfolio manager is facing all these portfolios, what he's got to do is move all these dots to the green line. Now let's compare these two portfolios over here. They both have the same expected rate of return, but the one on the left is a better one because it has a lower standard deviation or a lower risk. So once the manager gets to the green line, the manager then must use what she knows about the client's level of risk aversion to pinpoint where on the green curve the client should be. A more risk-averse client should be further to the left on the curve, and one that can take on more risk should go to the right. Selecting an investment manager is an important process. It is a daunting task. Even the smartest can be fooled into selecting a subpar manager. Many in this industry are experienced smooth talkers. Selecting an investment manager is similar to selecting a spouse. Once you have made the selection, it is very difficult to reverse the selection. Like a spouse, the longer you've been in a relationship with this investment manager, the more you know about them, and you might end up finding some surprising things. So what are some of the things we're looking for when we are choosing an investment advisor? Well, the most important characteristic obviously is ethical. And it's important that the investment manager has a written standard of conduct available for your review. And then the investment manager must disclose all conflicts of interest and must understand them. And of course, the investment manager should put the client's and beneficiary's interest ahead of one's own. And then there is fair dealing with clients and beneficiaries. Full transparency is very important. And in this day and age, the only way you can get full transparency is having real-time online access to accounts. The investment manager must be completely truthful to clients and quick to disclose mistakes, and should disclose all material information regarding the administration and investing of an account. And really importantly is the investment manager should treat all their clients equally regardless of the account size, so that they're not running trades for one account ahead of another account. Accessibility is very important. And then finally, sound record keeping. We also want a competent investment manager. This is very hard to determine, and it even fools the smartest. So here are some of the criteria that folk use: a designation, academic training. Journal articles are very helpful, particularly for refereed journals. If they're published in a refereed journal, that probably is one of the greatest signs of competency. Years of experience, reputation, and then most important, asking questions at the interview and trying to determine if the answers to all these questions are consistent. We need to monitor the portfolio and evaluate the investment manager. Contrary to conventional wisdom, evaluation is not merely looking at performance. It is much more. In this day and age, we need adequate online access to our account where we can get up-to-date holdings and transactions, and also a recording of all the historical values as well. We need to monitor asset allocation and ensure that they are within target. Recently, with the rise in U.S. equity markets, the asset allocations in equities has risen above target for many portfolios. When this happens, we need to rebalance these portfolios. We need to monitor portfolio turnover. For long-term strategies, buying and selling constantly should not be needed, and it shows an inability to stick to a strategy. We need to monitor diversification within all the asset classes. We need to determine if expected opportunities and risks were met. If not, why? We need to ensure the risk of the current portfolio. In the case of multiple managers, we need an online aggregator. Most important, are the transactions consistent with the manager's stated strategy?
The investment manager helps the governing board meet its fiduciary duties. I have already discussed the theory behind the laws governing portfolio management. An investment manager is supposed to take a pulse of risk tolerance and then use diversification of securities to reduce risk while maintaining return. An important factor in setting risk tolerance is time horizon. Young individuals have a longer time horizon than older ones. As a result, they can usually carry on more risk. Establishing a time horizon for a nonprofit is more complex. Some nonprofits, such as schools, wildlife protection groups, or hospitals, have an infinite time horizon. We hope they will always be with us. Others, such as the Alzheimer's Association, hope that there will be a day when they are no longer needed. Time horizon is an important issue that all governing boards need to discuss. I have provided a simple overview of risk measurement and diversification. In reality, this is much more difficult to put into practice. It requires specific skills, data sets, computational resources, and information on various investment alternatives. More importantly, it requires a level-headedness, especially during the time of crisis. And I can't repeat this enough. Everyone in the wealth management business makes mistakes. One does not violate fiduciary duty by making a mistake. If that were the criteria, then nobody could do a fiduciary. The best that an investment manager can do is to form their return expectations using thorough research and analysis. And this is not always foolproof. There can be times when randomly selected securities will outperform portfolios constructed with a carefully constructed strategy. However, that is not an argument for randomly selected securities. For an analogy, you can drive on a small country road at 90 miles an hour with no seatbelt and still survive, but that does not mean that you should do it.
This is a visual of the initial stock market fallout when COVID-19 hit. Prices would fall and then move back up again. We had a series of false recoveries, and the overall downfall looked frightening. In any downfall, it's important not to panic, but this is hard to do because these are scary times. We don't know when and if we will bottom. It is difficult during these times to forecast the future. We need to fully grasp and inventory all the things we don't know. Our biggest mistake is after the recovery occurs, we look back and judge the investment manager during the period of downfall when we have the hindsight that she didn't have during that period. This visual outlines the S&P 500 path from the various crises that we've had in the past. The 1973 Arab oil embargo, the dot-com crisis, and the 2008 financial crisis. While the lengths and the bottom of all these crises vary, they have always recovered.
This ends our presentation. Nonprofits make our world better by doing so many different things. Caring for the ill and vulnerable, educating our youth, and protecting our environment. I could go on. One essential ingredient for a successful impact is sound financial management. This is a daunting task because it requires setting an investment strategy for an unknown future. So, we have to balance both risk and opportunities in an objective, alert, and informed way. Mistakes are inevitable. When crises come, calmness and alertness are the key virtues. And during the crisis, we should understand all the uncertainties that our investment manager faces, rather than making judgment after the crisis when we have perfect hindsight. And in the end, good investment management requires hard work and foremost, trust. It is not about winning and losing only. High performance while breaching trust is not sustainable in the long run. And without trust, our financial system cannot work. And we have seen this over and over again. This gets its value through trust. It is not backed up by gold. It is not backed up by silver. And this trust comes by being accessible, open, and transparent. And when we win the trust, then we can work together to make this a better planet. Thank you.